I guarantee your fund manager is going to underperform in your pension. How can I make such a guarantee with such great certainty? And it's because of the data that we know time and time and time again, year after year, that the vast majority of funds, 91% domestic funds, large cap funds, 87%, over a 10-year period, underperform the benchmark. Now, the benchmark is an index you could just track using an exchange traded fund. Same with international funds, 87%. Whilst this is for US data, the same applies for the UK. So, well, that's not a guarantee, Alpesh. There's a few who slip in. Yeah, the probability you're going to get one of them is pretty minuscule. It's a bit like me saying, I will guarantee you're not going to win the lottery this weekend. Okay, so why is it that these professional fund managers, who are, of course, the experts, and surely if this was the case, there'd be laws against it and it would already have been stopped? Well, Eugene Fama got a Nobel Prize in economics a few years ago for pointing this out and showing the mathematics of the reasons why. So let's look at many of the reasons why fund managers underperform and why asset management companies are very good at marketing, like a St. James's Place or a Scottish Mortgage Investment Trust, or brokers are, like a Hargreaves Lansdown or an AJ Bell, to try and sell you funds. But the system is set up in such a way that you're going to lose money. Now, first of all, they use the fees they earn from you giving them money to market to get more clients. I'm not saying it's a Ponzi scheme, it's not, but that's where they get the advertising revenue. And as Fisher said, who writes for Forbes magazine and has a fund management company, 80% of asset management is marketing. Okay, so once they've got you into their funds and they're getting fees off you, what is it that stops them from outperforming the market? Of course, highly educated people all went to the right universities, so how come they can't get the stocks right? Well, it's not so much they can't get the stocks right. Let's say they happen to pick an Nvidia, Microsoft, Meta, Alphabet, Apple, whatever. And very often, if they've got the remit to do it, they will. The problem is, first of all, they often won't have the remit. These fund management houses have so much money, they have to divide it into different geographies. So one fund manager is only allowed to buy Japanese stocks or European stocks. So they're picking from a very narrow group of companies. So they've got their hands tied behind their backs. You might think, well, that's okay. I'll buy a bit of that guy's hands tied behind his backs and a bit of that guy's and I'll be fine. Doesn't work like that. If they're only picking from a small group and that small group does poorly, you'll do poorly. But let's say they're not restricted by geography or style, like only value companies, only growth companies, only income companies. And we happen to know that undervalued companies which are growing tend to do better. But let's say they've got no restrictions at all, and there's very few funds like that. Then the other problem they've got is because they've got so much capital, they tend not to put a large enough amount for significant growth in those important companies that you might want to put more in. So they might only put 3% in an Nvidia. You might have wanted 5, 6, 7%. And similarly, if they do put 3% or 5% in their top pick, the one they're most confident about, they'll put significantly less in the rest, and they end up spraying and praying, having lots of money in lots of companies. No good for you again. So what then is the third reason why they underperform, other than underinvestment in good companies, too much capital, and restriction by geography, style as well? Well, the third one is when the markets fall, and it only happens, thankfully, roughly once every 5 years, but the falls can be significant, they can't go into cash. So what happens? You're held in a sinking ship. You've got a bit of a Titanic situation going on. You can't get off. Of course, you can avoid all of these problems by having the transparency of the data and managing it yourself. But in order to do that, you need the data and you need the knowledge. Anyway, have a look at alpeshpatel.com/links. Have a look at the links in the bio. If you want to do more of this yourself and not just be, on the Titanic with pension funds, because we know from the data that ship's going to sink.